Welcome. This is Introduction to Repositioning Apartment Buildings, Wealth Creation Through Syndication. My name is Jeffrey Smith. This is my standard disclaimer. This information is provided for educational purposes only. Although I believe it is accurate and authoritative, I am not engaging in legal or accounting advice. If such advice is required, then the services of a competent professional should be sought. This is not a solicitation for investment securities. Objectives: identify profitable projects, analyze the operating data, structure the financing, acquire and execute the business plan, refinance the stabilized property. This is a hypothetical case study. Highland Residence Apartments. That's not its real name. This is not its real picture. The intent is to explain the basic parameters of a good repositioning project. The property type is an apartment, a garden-style apartment. The rentable square footage, 65,000. Rentable units, 78. Repositioning analysis. Anticipated project duration is 12 months. Acquisition closing costs, $19,400. This is a 2.5% guesstimate of the maximum allowable offer. Cost of repairs, $93,600. That averages $1,200 per unit. Some units need light rehab. Down units need moderate rehab, so the average is about $1,200. Contingency factor of 15%. We'll add a little bit more to this value of $93,600 plus $14,000. No carrying costs. Total repositioning cost guesstimated at $127,000. This number will be fine-tuned once we get the property under contract and have a general contractor go through and prepare a thorough scope of work estimate. The property is distressed with weak management, down units, and high expenses. No apparent structural issues. Most units require light rehab, which can be deferred until tenant turnover. The down units require immediate moderate rehab. The property needs new management for turnaround and stabilization. Let's look at the operating data. Actual operating data compared side by side with the pro forma operating data. You can see the vacancy and credit loss on the actual side is $162,000. On the pro forma, it's about half of the actual. Also look at the gross operating expenses. On the actual side, $159,000. On the pro forma side, $182,000. We are assuming that from improving the occupancy rate, that is reducing vacancy and credit loss, that there will be more operating expenses involved with this property. So the net increase in operating income is approximately $60,000 through the stabilization effort. The distressed property has positive net operating income that can service short-term, high-cost private debt. This is an ideal repositioning candidate, provided that the property can be acquired at the right price. We start with the pro forma to calculate the after repositioning value, the ARV. Then calculate refinancing debt structure and work backward to the offer price. After repositioning valuation, we calculate the ARV as $1,818,211. Retained equity is 30% of the ARV, $545,000. The refinanced debt present value $1,272,748. This is 70% of the ARV. This is right exactly in line with commercial mortgages. 70% of the ARV, 70% of the value of the property. From that, we subtract about 3% of the debt present value for closing costs, leaving $1,234,566 to pay off the repositioning financing and to recover the common equity investment. We redeem the repositioning future value, $847,343, to arrive at net cash out proceeds of $387,223. This is the cash out that will be divided among the common equity holders after repositioning. We are assuming that the refinance debt has an annual interest rate of 6% with an amortization term of 300 months, that's 25 years. The annual debt constant comes to 7.73%. It's slightly higher than the interest rate because it also includes principal repayment. The debt yield is 15.46%. This is an excellent debt yield for the lender. If the lender makes the loan today and forecloses tomorrow, then receives the full net operating income, that income would represent a 15.46% yield on the investment. The debt annual service, $98,404. Monthly service, $8,200. The debt coverage ratio on the refinance is 2.0. So the debt coverage margin is the reciprocal of the debt coverage ratio. That's 50%. 50% of the net operating income is dedicated to debt service. And the remaining amount, the cash flow margin, 50%, is dedicated to the owners. The refinance capitalization rate, the effective cap rate, is 10.82%. The gross return on retained equity, this would be the cash-on-cash return on the equity portion, 18.04%. However, the retained equity is entirely created equity. You've created that value out of thin air, so your cash-on-cash return is actually infinite. You have no net cash invested in this deal after you refinance. The break-even occupancy rate is 61.44%. And the pro forma cash flow before taxes annual is $98,404. That's because you have a 50% cash flow margin. Monthly is $8,200. This will be split amongst the common equity shareholders. Repositioning financing. Now that we know what the ARV is and how it will be financed, we can then calculate backwards to determine our maximum allowable offer price. We start with private debt with net proceeds of $812,668. That's 90% of the investment to value on this project. Private equity investment, $90,300. This will be raised from private common equity investors, 10% of the ITV. Total investment to value, $902,968. That is less than 50% of the after repositioning value. We then subtract our estimated total repositioning costs to arrive at our maximum allowable offer, $775,968. We then calculate what the structure is for the first position private debt. The present value, $855,440. We subtract the 5% margin incentive fee. This is sometimes called an origination fee or discount points, whatever it is. I call it an incentive fee. It's a 5% margin. The debt net proceeds is $812,668. That's the actual cash that we receive from the lender, even though we're signing a note for $855,440. I'm presuming that the first position private debt annual interest rate is 10% annual. However, the effective yield to the lender is 15.45% because of that 5% margin rate. Amortized over 300 months, 25 years, to calculate the principal and interest payments, the annual constant is 10.90%. It's 10.90% effective because this property, under its actual operating data, can support the entire debt service of this private debt. If the net operating income was less than the required amount or negative, then the private debt would be a 0% effective rate, and the interest would simply compound to the final balloon payment. The debt yield on this first position debt is 16.90%. That's a very safe debt yield. If the private lender were to make the loan today and foreclose tomorrow on the actual operating data, they would receive the net operating income, which would be 16.90% return on their investment. This is a very safe loan for this private lender. Calculate the monthly payment and the annual payment. And the future value, this would be the balloon payment due in 12 months, $847,343. It's less than the debt present value of $855 because there is some principal repayment in this financing structure as well as full interest coverage. The debt coverage ratio, 1.4723. This is a very good debt coverage ratio for a repositioning project. There's plenty of cash flow left over after servicing the private debt to service the common equity investors. The capitalization rate, 17.70%. The gross return on equity, 48.79%. The break-even occupancy rate, 55.5%. And the gross cash flow before taxes annual, $44,054. This would be divided among the common equity holders. And the monthly is $3,671.